Everybody thinks passive income is this magical tax-free money fountain, and honestly, the government loves that you think that. Let's blow that myth wide open right now, because what you don't know is quietly eating your returns. The term passive income sounds like money that just floats into your account while you sleep, untouched by the IRS, but that's not even close to how the tax code sees it. The IRS has a very specific, very legal definition of passive income, and it has nothing to do with how hard you worked or didn't work. Rental income, limited partnerships, and certain business activities. These are what the IRS actually classifies as passive, and they come with their own rulebook that most people have never read. Think of it like a VIP section at a club. You think you're getting in free, but there's still a cover charge. It's just a different door. Here's the kicker. Passive income is generally taxed at your ordinary income tax rate, not some special lower rate, unless we're talking about qualified dividends or long-term capital gains, which are entirely different animals. So if you're in the 32% bracket and you're collecting rental income, congratulations, Uncle Sam is your silent landlord. Now, there was a moment, maybe around 2017 with the Tax Cuts and Jobs Act, when people thought passive income investors had finally caught a real break. And some did through the 20% pass-through deduction on qualified business income. But the eligibility rules are so tangled that countless investors left money on the table simply because they didn't know what they qualified for. The psychological damage here is real people hear passive and mentally check out on the tax planning, assuming someone else has handled it or it somehow handles itself. Robert Kiyosaki built an empire on the idea of passive income freedom, but even he has a tax team working overtime to make sure that freedom doesn't get fully reclaimed by the federal government. Historically, the passive activity loss rules, introduced in 1986, were specifically designed to stop wealthy investors from using rental losses to offset their W-2 income. And those rules are still very much alive and kicking. The irony is that the very laws meant to close loopholes for the ultra-wealthy ended up trapping everyday real estate investors who had no idea the trap existed. One of the biggest misconceptions is that if you lose money on a rental, you can just write it off against everything. Nope. Passive losses can generally only offset passive income, not your salary, unless you qualify as a real estate professional under IRS standards. And qualifying as a real estate professional requires more than 750 hours per year in real property activities, which is basically a part-time job, making the word passive feel like a cruel joke. What history actually teaches us is that the investors who win long-term aren't the ones chasing tax-free unicorns. They're the ones who build their portfolios around tax-efficient structures like LLCs, cost segregation studies, and depreciation strategies. Depreciation alone, which lets you deduct the theoretical aging of a building over 27.5 years, is one of the most powerful and underused tools sitting right in the tax code. The practical move here is not to panic, but to get strategic work with a CPA who specializes in real estate or investment income before you file, not after, because fixing a tax mistake retroactively is painful and expensive. Position size matters here too. Spreading investments across different passive income streams can help you use passive losses more efficiently, rather than letting them pile up unused, like coupons you forgot to clip. The discipline isn't in finding a loophole, it's in understanding the system well enough that the system works for you instead of against you. Process beats conviction every single time, and the investor who files correctly 10 years in a row will always outperform the one who got lucky once and paid the price for years after. At the end of the day, passive is just a word, and words don't pay taxes, strategies do. The investors who treat tax planning as part of their investment process, not an afterthought, are the ones who actually keep what they earn. You don't have to be a tax attorney to get this right. You just have to stop assuming the word passive means the IRS is asleep at the wheel, because they are very, very awake. Preparation isn't pessimism. It's the smartest form of optimism you can practice as an investor. Whether the tax code shifts or stays the same, the fundamentals of disciplined, informed investing always win. Sizing your positions correctly, staying unemotional, and building systems that survive any tax environment. Consistency in your strategy will always matter more than trying to time a loophole. If you're ready to start building real passive income streams the right way through real estate investing, home contracting projects, or connecting with the right lenders, check out the links in the description below and let us help you get started.